The Money Show.
Personal Finance with Warren Ingram.
Warren is a director at Galileo Capital. He's also a personal financial advisor, and he's with us on The Money Show this evening. Financial success in retirement feels a bit like an oxymoron, really. It's one of those things that very few people ever succeed at. What is it? 6% of people who retire will do so in a lifestyle to which they've become accustomed, or will retire successfully, something like that, Warren?
Yeah, I always give credit to Maya Fisher-French for this, because she says it's actually 6% of salary earners in South Africa will have a measurable life, decent lifestyle in retirement. So it's a tiny fraction of.
What did I do?
Did you talk over me there?
I must have talked over you, and then I cut you off. So I won't do it again.
For this show. So when we talk about Maya Fisher-French, she'll tell us that 6% of salary earners will get to financial freedom at retirement. So it's a really small number of South Africans in reality. So you're right. It's a very difficult thing to actually achieve.
How do we ensure we become part of the 6% or grow the 6% to a bigger number?
I think there are a couple of things. One, that it's important to understand when you start living off your money, it's a totally different dynamic psychologically than when you're working for a salary. And people who are built up capital and have capital to live off, they find the first 2 to 3 years of their post-working lives to be really stressful, because the first big market drop that they experience, and unfortunately we've got a whole new generation of people in that position right now, that first big market drop, it reminds them that when money goes out and when the investment values go down, that they're not going to be able to get up tomorrow and go and use their labor to generate a replacement money. So what happens is the psychology for them becomes really, I guess, on point. It becomes something that almost is crushing in terms of pressure, and often forces them to make, I think, pretty poor investment decisions at the worst possible time of life. When they should be most rational, thinking, most long-term, they become incredibly short-term in their time horizons, and hugely emotional. And unfortunately, logic and reason often go out the window temporarily. So I think the first thing is understand that when you're in this position and markets are going down, almost the worst thing you can do is make a major change to your investment strategy. That actually applies to pretty much all of us. It doesn't matter if we're building up money or living off our money. When markets are falling dramatically, making a kind of a complete change in your investment strategy is really probably going to be the worst thing you could possibly do. In most instances, actually just staying the course and sticking to the strategy you had before the market drop will be most rewarding for you, and making any changes will probably be punishing to your investment returns. So if you are going to make changes, there need to be changes based on something changing in your life, not because of market conditions. And I think that's probably for me an absolute key point, and a key mistake that I see people making in times like this is they just need to take action. They need to do something because the markets are down. They have no control over markets. They have no control over currencies or bond markets, or what's going on in terms of news flow. And so the only sense of control that they have is to change something in their own investment strategy. And most likely, if the investment strategy was good before the market crash, the investment strategy was built for market crashes, and therefore should not be changed, almost under any circumstances, and unless your own personal circumstances change. So I think that's a big one.
Doing nothing is the hardest action to take, because you think it's inaction, but actually it's an action, because it's a deliberate decision to do nothing.
Exactly. And our brains are not programmed to be calm and logical and rational in times of great stress. I mean, when we kind of were being evolved in the wild, the reason we survived and the reason we're still here is because we had finely tuned lizard brains that would either tell us to fight or to run, and those were really good instincts when our lives were under threat. Unfortunately, that fight or flight instinct is really not helpful when you're looking at investment markets and your brain is, firing, signals at you to say, well, do something, take action, and don't just stand around doing nothing, you idiot. But unfortunately, that's the time not to listen to that part of your brain. That's the part, the one time I think where you kind of sit down and you say, actually, I need to kind of fight my base instincts and try and just calm down, let the rational brain take over and understand what's going on, and then do nothing. And if you're in doubt, sit down, do nothing again, and keep doing nothing until that kind of impulse drive is gone. Because unfortunately, that impulse drive is not good for you at all in investment markets.
Right. Okay. So when I think there are probably a handful of factors that if we do a handful of things right, then we'll be better off than doing a handful of things wrong. What do we have to make sure that we get right in this process, other than when things are going pear-shaped, doing nothing, which is the hardest thing in the world to do?
Yeah, and then you can kind of curse at us when it's difficult and it is hard and you're doing nothing, but well done, you're doing the right thing most likely. So I think the first thing is you make sure that when you've got an investment portfolio and you're living off that, you cannot be too cautious or too conservative in the way that you invest that money. In other words, overexposing yourself to cash and to gold and to relatively what might seem like stable assets. I mean, it's hard for me to say gold is stable, but for some people they like gold. But those are assets that have no real history of beating inflation over long periods of time. Unfortunately, the assets that give you the best likelihood of beating inflation over long periods of time are the ones that are most spoken about, most written about, and generally the ones that are most rocky and volatile. So we're talking about shares and property companies, and those are, I would call them growth assets, and certainly those growth assets give you a really good return on your money over long periods of time, and possibly a heck of a ride over short periods of time. But that's a thing that you need to make peace with before you start investing, and then make sure that you've got sufficient exposure to those, and sufficient exposure. Just to kind of give you a range is, I think if you've got less than about 35 or 40% of your investments in growth assets, you've got certainty, you've got a very stable, very predictable portfolio, but most likely a portfolio that's not going to beat inflation over long periods of time. So you have to have more than 40% in growth assets. And in fact, look at the pension fund laws where they tell you, you can have a maximum of 75% of a pension in growth assets. I think that's a very good benchmark. It's a very rational, very sensible benchmark, and applies to almost all of us. So your range is 40 to 75% in growth assets, and then you've got to stay in those growth assets when things get rocky. So to me, that's probably point number one and the most important point. The second, which is a drum we both like to beat, you've got to keep your costs at a reasonable level. You can't be oblivious to what your investments cost you. You need to understand that costs, paying a fair fee for fair service and fair implementation of your investments is right. Paying too much money, unfortunately, all you're doing is you're making the financial services providers and their shareholders rich, and giving yourself a very poor chance of getting a good outcome over your retirement. So you must focus on fees and understand what you're paying. And don't be afraid to ask the hard questions. The number you're looking for, the jargon in the industry is total investment charge, TIC, and that's the number you need to understand. And if that's over kind of 2.5%, you're paying too much. Ideally, below 2% is a good number.
Is that total investment charge manipulatable? That's a new word. Can I say it's a total investment charge, excluding 5 charges that are so small we don't put them in, but it is, because we've seen schlenters around charges for an awfully long time. Is total investment charge now the industry standard? Is this there is an absolute requirement of everybody to make this disclosure in exactly the same way, so there can be no ducking, diving and obfuscating?
Yeah, that's why you get paid the big bucks in your role, because you can spot the smoke screen. So there is a smoke screen in this, and the unit trust industry is pretty transparent nowadays, and they adhere, I think, very well and very strictly to this TIC. But then you go and look at the beloved insurance companies, and they don't like that number, so they'll use something called a reduction in yield or some other kind of a smoke screen, and then they'll say to you, that over 1 year your costs will be one number, but over 5 years, if you stay in, it might be a smaller number. So unfortunately, it's not absolutely transparent. But I think when we're dealing with pure investments, especially in the unit trusts or shares or exchange traded fund space, then I think TIC is a good measure, and certainly one that you can rely on fairly well, Bruce.
I would like to have an ATIC number, absolute total cost of investment, or whatever it is. Oh my goodness me! There are just too many nooks and crannies to hide in. Warren Ingram, our guest this evening on a Thursday night. He is a personal financial advisor and director at Galileo Capital. Tim has sent a lovely question. Thank you, Tim. I want to start investing directly offshore. I hear people talk about an allowance you can use for this, while others talk about needing SARS approval. Could you please provide more detail to clear up my confusion? Good question, Tim. Good question indeed. We will get Uncle Warren to explain in a moment.
The Money Show.
Personal Finance with Warren Ingram.
Tim wants to invest directly offshore. I don't know if that means go and buy individual shares, or it means going to buy investment trusts or go and buy unit trusts or anything like that, Tim, but we'll discuss the principle. Offshore allowances, when do you need SARS approval? Tim needs details. Warren, first things first, let's talk about the allowances and the amount of money that you are allowed to remove from the country without asking anybody any permission.
So the SARS calls those the single discretionary allowance, and what SARS allows us to do is, in a calendar year, so from 1 Jan to 31 December, we can send out R1 million a year under the single discretionary allowance. We don't need to apply for any permission to do it. What we are required to do is to do it through a foreign exchange dealer, and pretty much all the banks in South Africa are foreign exchange dealers, and then there are a whole lot of additional companies that specialize in sending money overseas. So what happens there is that the foreign exchange dealer is keeping record and informing the Reserve Bank that you have used a portion or all of your single discretionary allowance. And so that's how they track that you're doing up to $1 million as a maximum in a year. Important to know with that single discretionary allowance, it's also what used to be the old travel allowance. So it does cover things like your hotel, any credit card spend that you incur overseas as well. So if you're going to invest money overseas using the single discretionary allowance, great way to do it, because it's much quicker and much more efficient for you to go through. But just remember that that means you can't use the whole R1 million if you're going to invest overseas. To travel overseas as well.
So if you've ordered some stuff on Amazon and you bought somebody a gift from Harrods and had it delivered to their home, and that cost £100, so that's 2,000 Rand. And then you bought something on Amazon for 1,000 Rand. Suddenly you've only got 997,000 Rand left that you can now play with. And then you decide to take an overseas trip, and that costs you 100,000 Rand. Now you've got 897, and then that's all you've got that you can now invest, because your total allowance is that R1 million. If you go over it, your bank is required to report you to the Reserve Bank to say Warren's being naughty, he's taken too much out the country, and or to stop you taking any more out the country. They're like the traffic cops, if you like, of the Reserve Bank in this case.
Exactly right, and usually what happens is it might not be flagged immediately while you're trying to do that transfer, but the record keeping is good, and so then you get a polite inquiry from your bank saying we've had a not so polite inquiry from the Reserve Bank, and we all need to now go and please explain ourselves. And you need to know that as an individual, you can't go and blame the bank, the responsibility is yours to keep track of the money that you send out. And it also doesn't help you to then go through 5 banks to do this and hope that no one will catch you. Anecdotal evidence is that you certainly do get caught, and then you have a lot of explaining to do. So just don't put yourself at risk. If you know you're going to travel, then rather, at the start of a year, if you are going to use the discretionary allowance, start with 700,000 or 800,000, whatever it is that you will not spend too much money on your travels, and then towards the end of the year you can say, well, actually I didn't travel at all, or I only spent 50,000 on travel. I've got an extra 200 or 250,000 that I can use in my discretionary allowance, and that's a way to manage that. You also, between a husband and wife, for example, that means you can each do R1 million as well. And it applies to everybody over the age of 18 who are South African. So it does end up being quite a lot of money, per family, and certainly, over a period of time, a very easy way to go. So if I'm Tim, and I want to get my money out reasonably quickly without waiting for SARS and all of that, this would be the way to do it. One very important point is, it is still an asset that you own, and we do still have a tax regime which is based on where you live. So the fact that you've sent this money out, you need to put it into your tax returns in the future as an asset that you own. And if you're earning interest or dividends or anything like that, you must declare that in your tax returns. Otherwise, you're going to make SARS unhappy, and not just the Reserve Bank, who might still be fine with everything. And believe me, you really don't want to upset SARS nowadays. So make sure that you keep your records clean on the money that's gone out, and a clear track record in your tax returns.
And we saw what happened yesterday with Marcus Jooste. You make the Reserve Bank unhappy, and it might take them 5 years, but they will spend, as the Reserve Bank governor told us this evening, a huge amount of money to hunt you down and follow their rights in this particular matter. And then, of course, if you've won the lottery and you decide you want to take 20 million rand out, there is a process, but get some professional help with that, I would think, because, it's just ensure that you do fill in all the boxes correctly. You can do it, and the mechanisms to do it, but you need permissions, and you need declarations and paperwork for that, Warren, just in 30 seconds.
Yeah, so you're allowed to send out 10 million rand a year, and that, just to complicate things, is not necessarily in a calendar year. It's in a 12-month period from when you start the application, or when you get your first approval, and it is quite a complex kind of reporting thing. So I would suggest you do use a tax advisor to help you with that. But SARS doesn't have a problem with you sending the money out. They just want to know that you legitimately earned this money, and it's not that you've declared 1,000 rand a year of income for the last decade, and then suddenly you send out 10 million rand. That's the problem that you're going to face then, if you've been doing that. But otherwise, it is a little bit of a process, but then you can use the full 12 months to send that money out as you wish. So not a bad process to go through, just painful paperwork and a few weeks of hassles.
Thank you very much, Warren Ingram, as always. Warren, Director, Galileo Capital, personal financial advisor, wrapping up with Tim's question this evening to The Money Show.